Aptus Value is the other stock in focus on the back of a credit rating upgrade, which could hugely benefit the company's cost of borrowings. We'll be joined by the management in just a moment, but before that, let's bring in Harsh to give us more context. Harsh.
Well, yes, it's a credit rating, credit rating upgrade, and it erstwhile the credit rating was AA minus positive. Now it is AA stable. So that's the credit rating upgrade, which is reflecting on your screen. But most importantly, what does this do to cost of borrowing? Does it come down? That's the first thing I want to understand. The second thing is with regard to the repo itself. We've seen a sharp downtick with regard to the repo in the last 4 months. How does that impact cost of borrowing as well? And both of those mutually exclusive. And I'd want to understand whether transmission of rates, how much of transmission will happen, how is competition looking at transmission of rates as well. It's a competitive space to be in. And last off, impact of all of this on the ROA number.
Well, Harsh, we'll try and probe some of these points for sure. P. Balaji, Managing Director of Aptus Value Housing Finance, joins us right now on the show. Mr. Balaji, good having you. Thank you so much for taking the time out and speaking to us. To your mind, what does such an upgrade do in the current context wherein the tailwinds are very, very strong for lending profitably and quote unquote making money?
Good morning. As Harsh rightly told, the upgrade is from AA minus positive to AA stable by care. And actually, if you look at this upgrade, there are two benefits that will accrue to the company. One is diversification of borrowings as mandated by RBI, which means we'll be in a better position to negotiate better borrowing rates and also the amount with insurance companies and mutual funds. So that is one thing which is going to help us. Then the next thing is obviously the reduction in the cost of borrowings because of this upgrade. There will definitely be at least 0.25% reduction in the cost of borrowings on the incremental borrowings. Now, Harsh's next question was that, for on the existing borrowings, what could be the impact with the repo rate being cut by 1% by RBI? What does this mean to Aptus? If you look at our total borrowings, it's almost 57% is linked to variable rates and 43% is linked to fixed rates, which means for 43% of our borrowings, there will not be any impact on the cost of funds. For that 57%, again, if you break that into two, 30% is linked to market related rates, either a repo rate or a T-bill rate, which means this 1% reduction on that 30% of the borrowings will come immediately. As we see it as of today, 0.6% has already come in, so 0.4% is yet to come. It will come in any time. And as regards this balance 27%, which is linked to MCLR, it depends on the banks to pass on the rate cut benefit to us. As I see it, it will take at least 3 to 6 months for us to get that benefit. Having said that, what is happening is on the incremental borrowings, we have already seen 0.4 to 0.5% reduction in the borrowing cost, which means we are negotiating rates at around 8 to 8.25% for the housing finance company. So that is actually going to result in a huge benefit for us. And as regards the passing on of the benefits that we are getting on the cost of funds, maybe we need to, if you look at our loan book, 20% of it is linked to variable rates, which means for that 20% maybe we might have to pass it on in this quarter. But for the balance, 80% is based on fixed rates, so we don't have any. We are not under pressure to pass on those benefits. Of course, if the if the benefits are coming through us more, then maybe we might have to pass on some of the benefits to the ultimate customers.
So Balaji, you've answered a lot of questions that we didn't ask, and I'm glad you heard Harsh listing out the things that he would like to know, and you've answered quite a few of those things. But I do want to understand, you've pointed out for incremental borrowing, 0.25% is what is the benefit that is likely to accrue to you on account of this rating upgrade. I'm just trying to understand also in terms of refinancing of your existing borrowings, because that is something that you can potentially do as well over the course of the coming quarter. We're starting a new quarter, and I'm guessing that is when things will start rolling on the ground in terms of your borrowing, and over the course of FY26, how much of your book do you anticipate that you will be able to refinance, and what is the implication towards the last quarter of the current financial year in terms of the spreads that you will be able to generate and what will accrue to your book?
If you look at the refinance, it depends on our, of course, this upgrade is going to help us, but we need to negotiate hard with the banks for getting the refinance benefits, because maybe the ones which are contracted at a slightly higher rate earlier, which are not, which are either linked to MCLR or the repo rate cut. To that extent, we might have to renegotiate hard, and then it depends on, while for that, I will not be able to give a timeline, because it depends on how fast the banks are able to accept this and then give back the reduction in the cost. So if you look at you were talking about the Q4 of this year, how much the cost of funds can reduce. Definitely, if you look at my 30% of my borrowing, which is around 1%, definitely that 0.3% benefit will come. And on the MCLR, which is around 27%, at least 0.5%. So which means at least 0.3 to 0.4 to 0.45% benefit should come in as a spread benefit.
Okay. I just want to sense also very quickly on the lending side, and of course that is something that you will benefit from in terms of the rate reduction that is taking place. What is your own estimate for the period that we're in right now? Do you anticipate that loan volume or disbursement will go up in the near term?
Disbursement, as we have been projecting, will be giving around 20 to 22% growth every year, and the AUM growth should be around 28 to 29% for the next 2 to 3 years. Considering the huge runway for growth and the market availability, we are confident of doing that.
Okay. Sorry, Mr. Balaji, just wanting some more detail there and just granular data, because the belief is that in particular housing finance, but everything else, which is NBFC, would have a fairly strong growth over the next 12 months at the very least, likely lasting much longer. Would you believe the next couple of years could be very, very strong growth?
Definitely, because if you look at we all know the mortgage penetration in India is low as compared to the countries across the world. It is just 10-11%. And if you look at the affordable housing finance companies who are operating in the tier 3 or tier 4 locations, the housing shortage is much more acute than what is there in the urban areas. So which gives us lots of potential for any of the affordable housing finance companies to grow fast. That is the first thing. Next thing is the government benefits, basically the subsidies under the PMAY scheme, and also the tax benefits that are available to the customers and the company is likely to be a guiding factor for the growth. So definitely in affordable housing finance companies in this area of serving the customers in tier 3 or tier 4 locations can see good amount of growth.
Mr. Balaji, thanks so much for joining us today. Absolute pleasure having you with us, and look forward to speaking to you in the near future as well.
Thank you. Thank you. Thanks a lot.